it's hard to imagine that we're not going to see a significant increase in global trade tensions. And the reason I say that is because we have competing needs from the two major players within the system, and this is true of the whole system. But in the United States, we've had extremely low savings rates, matched by very high savings rates in China. As part of the adjustment process in the U.S., savings rates must rise, and since it's unlikely that total investment is going to rise as quickly, in fact, total investment may decline, that means that the gap between the two, which is the trade deficit, is over the medium term is going to contract, or ought to contract. The problem is that in order for there to be a global balance, we would need to see the savings rate in China come down as quickly as the savings rate in the U.S. goes up. And that's very, very unlikely. The development model that China has followed, and which has been exacerbated by the fiscal and credit and monetary stimulus in response to the crisis, is likely to continue with a process in which total income, GDP, grows faster than consumption. Over the short term, you can change that a little bit by an increase in investment, but that increase in investment is probably not sustainable. So in China, you're going to have persistent high savings rates, and in the US, you're going to have rising savings rates. And that means that somehow or the other, there has to be an adjustment. And the brunt of the pain is going to be determined by the trade account. If the US trade deficit stays very, very high, that means that much of the adjustment, much of the pain will be borne by US workers. If the US trade deficit comes down very, very quickly, that means much of the pain will be borne by Chinese workers, by rising unemployment in China. And this is true with a whole bunch of countries. This is going to happen in Europe, and this is going to happen in Asia too. The way the burden of the adjustment is distributed will be determined by the trade account. So that means that the trade account is going to be highly politicized, and we're going to be spending a lot of time working on the trade account and deciding how the adjustment is going to be carried. In order for China to reduce its trade surplus, we need not that consumption grows. Everyone says that we need Chinese consumption to grow. Chinese consumption has been growing very quickly. In the past decade, it's grown around 8 or 9% a year, which is a much faster growth rate than in any other major economy. But that's not enough. The problem is that Chinese production is growing faster than Chinese consumption, so the gap between the two is increasing. Why is it growing faster? I would argue that the reason it's growing faster is because Chinese consumption growth is more or less in line with the growth in Chinese household income. So that national income, that is the total amount of stuff that China produces, is growing faster than household income. And the reason for that is that the development model China has followed, the very successful Asian development model, one of its key components is that the household sector, via low interest rates on their bank deposits, via an undervalued currency, and via a number of other mechanisms, are effectively forced to subsidize producers. The simplest way of thinking about it is through interest rates. With interest rates so low on banking deposits, that means basically savers are getting a portion of their income taxed away. Those low banking deposits translate into very low lending rates that are well below any definition of what the natural borrowing cost should be in China. So users of capital, which are mostly infrastructure investment and manufacturers, are getting very, very cheap capital, and that cheap capital is being subsidized by the household sector. So unless you reverse this process of subsidy, it's very, very difficult to get household income to grow much more quickly, and therefore consumption to grow much more quickly. And that's the problem that we face, because if you do eliminate the subsidy and even reverse the subsidy, the manufacturing sector, which is very heavily dependent on these subsidies, becomes very unprofitable. So we can't do it quickly, because if we do it quickly, we'll see a rise in unemployment in China. We have to do it slowly over 6, 7, 8 years. It won't be easy, but if it's stretched out over many years, it can be done. The problem is, if the developed world, if the trade deficit countries want a very quick resolution, then China is in a very difficult position because they cannot resolve it quickly. Well, most of the focus is on the currency, even though the currency is simply one of many factors, but it's the most visible one. And my guess is that China will appreciate the renminbi, but not by a lot, because if it does it too quickly, it runs the risk of what happened to Japan. In the 1980s, the Japanese postponed an appreciation of the yen for much too long, until it reached the point where it became politically very, very difficult. And it was forced to appreciate the yen very quickly, which led to all sorts of problems, as we saw. But much of the focus is on the currency, was on the currency back then, and will be on the currency currently. In that sense, it's very instructive to look at what happened in the 1930s, and this is based on work by Barry Eichengreen. And what Eichengreen argued was that in the 1930s, at the beginning of the trade conflict, a number of countries that were able to devalue their currencies did so. And it was the famous beggar thy neighbor devaluations or depreciations. A number of countries, however, were not able to depreciate their currencies. They included the United States and the so-called gold bloc nations. And what Eichengreen argues was that in the race, in the scramble to grab a larger share of this contracting net demand, the countries that were able to depreciate did so. It was the most efficient way of beggaring thy neighbor. But the countries that weren't able to depreciate, they then chose the second best set of policies, which was import tariffs or import quotas. And my suspicion is that we're going to see a replay of this. Countries that are able to intervene heavily to keep their currencies low are going to do so. Unfortunately, the United States and Europe will not be able to do so. The US won't be able to do so because most of the intervention is against the dollar. Europe won't be able to do so because as the dollar is forced to depreciate to bring some kind of balance to the US, and it can't depreciate against Asian currencies or against most developing country currencies, all the depreciation takes place against the euro. So the euro and the dollar and other floating currencies like sterling are sort of stuck. They can't depreciate their way into grabbing a bigger share of global net demand. So these are the countries that are most likely to resort to the second best set of solutions, which is to raise import tariffs. One of the mistakes we make is by looking purely at US-China relationships to understand the nature of trade tensions. But US-China is very important for symbolic reasons. If we start seeing a significant increase in US tariffs, that sort of becomes a signal that the rest of the world can also engage much more aggressively on trade issues. But the fact is that the most difficult trade disputes, it seems to me, are not taking place between the US and China. They're taking place between China and some of its Asian neighbors. For example, India and Indonesia have enacted some very, very tough measures. There's a lot of conflict and tension with China and Korea. Secondarily, there is also very, very strong trade tensions between China and Europe. I would say that trade tensions between the US and China, even though the US is running by far the largest trade deficit, have also been the least aggressive and the least painful. But I think that's starting to change. And if it does change, I think it has a very bad effect on the rest of the world, because I think once the US blatantly engages in trade protection as a response to Chinese policies, that sort of opens up the door for everybody in the world to be much more aggressive. In that sense, Smoot-Hawley, which is often a very bad example that we use, Smoot-Hawley was the wrong policy for the United States in the 1930s because the United States was the leading trade surplus country. As the trade deficit country, Smoot-Hawley is not a useful way of thinking about the consequences for the US. But what it is interesting is that once it was very clear that the president was not going to veto Smoot-Hawley, and I guess it passed in June 1930, that was a signal for the rest of the world. Some countries like Canada actually started before, once it was clear that the US was going to respond, to raise tariffs, and that began that great degeneration into the collapse of international trade. Well, I think it's very important for the US, China, and Europe to come to some kind of grand agreement. China has to recognize that the trade surpluses that it needs to absorb its excess capacity are politically not acceptable in countries suffering from high unemployment. the Europe and the US need to understand that China simply cannot adjust quickly enough. So in an ideal world, the leadership of the three countries would get together and work out a plan, 6 years, 8 years, however long it took, in which China committed to taking the necessary steps. Most importantly, raising the value of the currency, raising interest rates, liberalizing interest rates, and liberalizing the banking system. That would go a long way towards rebalancing the Chinese economy. It will be painful and it will be difficult, but it's what China is going to have to do one way or the other. In exchange, in order to make the difficulty much, much less, the US and Europe would commit to slowing down their own adjustments. That is, the US would continue to run large fiscal deficits in order to slow down the increase in savings in the US, and they would commit to keeping their markets completely and totally open to Chinese goods so that the adjustment in China can be slowed down over a 7-8 year period. Now, when I put it that way, I'm immediately a little bit pessimistic that we're going to arrive at that kind of grand bargain. At least, I think it's unlikely that we do so before things get worse. So my guess is that trade tensions are going to continue rising, and things are going to get worse especially for China, the trade surplus country. Trade surplus countries are always the ones most vulnerable to a contraction in global demand. Before we reach a point where leaders in the 3 or 4 major economies can come to an agreement over a long-term solution.